Hello, good morning. This is another episode of Two Grey Beards today on the 10th of February. We've had an interesting week, haven't we, Andy? We had the CPI revisions for 2023, and they were a total non event. Inflation is indeed where Waller wanted to see it for 2023, and he should be very happy because there was no market reaction, and yet we are on the path for the Fed to ease eventually sometime this year. What do you think?
Yeah, so the revisions, which are just a technical for 2023 in how seasonal adjustments are made, was a concern to Waller and to Powell because it was last year, it made it look like the progress had not been as steep. So for 2023, the concern was that the 3-month average inflation, which has been running at about 3.3% on an annual basis, is lower than the 1 year inflation, which is running at 3.7, 3.8, 3.9%. So they were saying that's progress. It's on the way down. And so there was a concern that progress would have been less steep. And so Waller and Powell mentioned it, and the markets were focused on it. And it came out as being in line, so that inflation is running on an annualized basis over the last 3 months at 3.3%, which is closer to target than the year over year inflation, which shows that we're making progress toward inflation. And so that's all that happened. And we also had three auctions last week, and those three auctions all went very well. They were well received by markets into a rallying market on Tuesday and Wednesday, and into a falling market on Thursday. And they all went well, and every one of them is underwater right now because the bond market continues to be duration continues to be oversupplied relative to demand, even though at the very instant of the auction, they come at a decent price. And so I think that's the big trend in fixed income. And we'll see CPI this coming week. Oh, so anyway, before we go on to next week, equities, on the other hand, continue to go higher, led by this narrow secular group that is beneficiaries of AI spending, and that is, in a very narrow sense, also benefit from weight loss drugs, but very narrow rally, but unstoppable rally. And while Russell is down for the year, the QQQs, the NASDAQ is up substantially, 6-7%. And that was the trend for this week. And so we go on to next week.
Yeah, no, the what concerns me is that the bond market had absolutely no reaction to the revisions, which were good. We have to say that the revisions were good because let's just recap what Powell and Waller have said. They want to see that the revisions do not negate the progress on inflation, and that's a check against that box. And then they want to see several months of inflation for 2024 being in line with what it was in 2023. We get the first of those numbers next week on Tuesday, and then they will be happy to decide at some meeting in the future that they can start easing rates to start and to attempt to keep the real interest rate somewhere below 2%. So we are ticking all the boxes, and there is no reason to expect that we will get anything but what the Fed has outlined in its dot plots for 2024 and 2025. And just to remind you that 75 basis points for 2024 of reduction in Fed funds rates and 100 basis points for 2025. Now, the question that poses itself is what if growth accelerates, even if inflation remains subdued at the levels that we are seeing? Does that negate the need for three cuts in 2024? And I think that is what the market is beginning to concentrate on. because there was absolutely no rally in bonds whatsoever after we had the revisions. And I certainly expected the market to do better. What do you think, Andy?
Yeah, so I look at the dot plot, and we're going to get a new dot plot in March. And let's assume inflation and growth and all those things keep trending at their levels, which is modest falling of inflation toward target and very strong real growth. I don't consider acceleration the word I would use, given that we had a 4.9% growth in Q3, 3.3% growth in Q4, and so far estimates are for well north of 3% growth in Q1. That's robust growth, which favors stocks over bonds. That's how we're positioned, and suggests the Fed needs to consider tightening. Now, the complex thing about growth is we don't know if it'll be inflationary growth or not. It could be a productivity miracle, and we just work better and smarter at a cheaper cost. And so you don't have a wage spiral, which doesn't create inflationary pressures. But the way things work is I look at a dot plot and I say, okay, what is the Fed's projection for GDP growth in this year? Because GDP growth matters to them, though they've been focused on the real rate. It matters through this transmission mechanism. They have a I don't remember if it's 1.2 or 1.4 projected GDP for 2024. And so the big macro question is, will the Fed be comfortable cutting rates when real GDP far exceeds their forecast, which it is on the path to do? And I don't know. The Taylor rule says they care about a third as much as the decline in inflation. So, in other words, if they miss target by 75 basis points on the upside, they need to cut 25 basis points less than if they beat inflation by 25 basis points. And so I think that's the big macro question. And you're getting some pushback from the Fed. They have some of the more hawkish members have mentioned the potential that real interest rates can actually stay higher in this post-COVID environment than they were pre-COVID. I'm a believer of that, strong believer of that. And so I'm going to look at the dot plot and the GDP as a portion of that, and how does that change in March when they don't cut, but they do release a new dot plot. And to me, the risk is that they cut less than they currently say. The odds of the dot plot in March going from 75 basis points of cuts, given the data, to 100 basis points of cuts in the following 6 meetings is very low in my estimation. I think the economy would really have to do something very unexpected on the downside for them to consider cutting 100 basis points in the dot plot. On the other hand, the odds of GDP staying high, inflation staying not coming in quite as fast, seem more likely. In that circumstance, you might see a GDP for 2024 increased. And really importantly, for 4 or 5 years now, they've been maintaining the long-term nominal rate on the dot plot at 2.5%. And if that number starts going up, which I think it should, but who knows, the terminal rate, the 2-year rate, the 3-year rate is going to be impacted by a higher end point to any cutting cycle. And so I think that's what's at play here. I don't know how it'll play out. We'll have to see the numbers. But I think that's what's at play here. And it still speaks to, as long as the real economy is strong and inflation is not below target, it's very hard to support bond yields at current levels.
Yes. And what it does is just favors equities, and especially high beta equities, against bonds and other low beta equities like the Dow. So it really is a very aggressive period in terms of risk, because everyone is buying very aggressive risk, i.e., high beta risk, and they are really neglecting the bond market, and they're also neglecting things like the Dow. We have no way of knowing if this is inning 3 or inning 9 in that game. But what I do know is that for the first time since 2000, the value of the tech stocks, of the tech sector, has overtaken the previous high, which was around 30%. And it's very rare that you will see when a sector busts through a previous high that it doesn't go at least another, I don't know, 4, 5, 6% before it reverses. It's very unusual that it only goes 1% and then comes back. So I think this game that people are playing, this running towards the bubble in the high beta stocks, is bound to continue as long as we have a Fed which is not going to hike, a Fed which is happy to keep real interest rates within a corridor. And therefore, people just say, wait a second, I can make 4.5% by buying bonds, but what can I make by buying high beta stocks? And the answer is you can make that amount in a month, and people have been. So it's not surprising to me that this trend keeps on continuing and that people keep on buying the Qs.
Yeah, the question I look at is obviously as more of a value guy than a momentum guy. I look at these stocks as of having questionable value at this level, but I'm going to defer to Nick on this. I think our portfolio is very defensive and can afford to take a bit more risk on this because we have nothing that I really dislike, like long-term bond exposures, lots of cash, and a medium amount of equities. So in that context, I'm willing to take a bit more risk. And the obvious trend is to stay on Qs over Dow.
Yes. Yeah, I feel that the Dow is really pointless at this stage because I do agree with you that long duration is going to get hit at some stage, or certainly the odds favor it getting hit over it rallying. And therefore, these defensive stocks are going to basically trade in tandem with duration. And if the odds are against them, then what is the point of holding them? On the other hand, if the economy, okay, reaccelerates might be the wrong word, but if it keeps on being as strong as it is, all the capex investment is going to go into tech, and the growth there is just going to keep on going. For sure, there might be some kind of a small correction at some stage, but the overall trend will remain intact. So I think upping that kind of exposure, and I will discuss that in my segment, is most probably playing the odds the correct way at this moment.
Yeah, I guess the only question I have, which is we've gone through earnings and there have been some outperformers on earnings, Microsoft and Meta in particular. Nvidia is now 5% of, is a third the size of most of the third biggest company I saw in even the S&P. Its earnings are in 2 weeks. Do we want to do this and then reconsider where we are based on price by the end of the week?
Yeah,
Or
we
you think,
will. We will certainly do that. I think it's worth taking the risk because we're playing the odds. But we will, of course, reconsider once we've seen the CPI data and we have a better idea about what the Fed is likely to do in March.
right. Okay, sounds good to me. And so really our macro is higher for longer. And the question that matters is whether the higher for longer real growth with declining inflation is enough for the Fed to say to pause further in terms of choosing to cut. We think March is off the table. We think it may come off the table with a CPI that's in line to warm. And then the question is, what does the dot plot say? And that's what we'll be focusing on the macro side.
Excellent. Speak to you next week.
Yep. See ya.
Let's briefly run through the changes that were made last week. And as advised, we got rid of the options that we had in the QQQs, the SPYs, and the Dow, and we exchanged it for shares which were worth about 35% of the portfolio. We kept everything else constant apart from the sale of the SHAI, which we think is now dead money, as we just had in this episode. We don't think the very short end is going to go anywhere until March. So our portfolio is very defensive. We have something like 16% in cash, and we can afford to take on slightly more risk. So this is what I propose that we do, and that we sell the Dow stocks and we exchange the Dow stocks for Qs. This will leave our overall equity allocation at the same 36%, but it will up the beta risk on the equity portion. Now, that is still a very defensive portfolio because, as I said, we will still be at 36%, but we will actually have much more risk. We have a lot of insurance here in the bond sector. If anything bad happens, these 3s and 4s are going to rally like crazy, and therefore they're excellent insurance. The VWOB is clipping a coupon over 7%. The USFR is clipping over 5%. So we have a lot of defensive insurance, and therefore I think upping this QQQ exposure is the correct play, especially in this election year, because I think that the odds of the Fed changing their dot plots in March, even though theoretically they should, because as Andy correctly said, growth is so much higher than they expected it to be for 2024, I think are pretty low. And therefore that might actually give a further spurt to something like QQQ. Certainly over a defensive area like the Dow, which will trade with long duration bonds. And if long duration bonds take a hit because they feel that the Fed is being, in inverted commas, loose, then this relationship between the Dow and the QQQs is going to diverge, and that is what we are positioning for, or certainly we're positioning for the risk of that happening. The overall equity exposure, as I said, does not change, but the risk increases. Having said that, everything else remains the same. The broker statements are uploaded and you can have a look at them anytime you like. The monthly performance is always updated here and you can see it all the time. And please remember that this is not a hedge fund. We're getting a lot of questions about aggressive plays. This is not what we are about. We do not want to maximize profit. We want to maximize profit relative to minimizing risk, and that is not the same thing. Thank you very much indeed, and speak to you next week.